All right, so in this video, I'd like to cover the most asked questions by people before they get into investing. And starting with the first one is really putting investing to the side for a minute and just think about one of the most basic economic principles, which is what happens to your money over time. And if you're familiar with inflation, it really means that your purchasing power continues to go down as time passes. Typical inflation is roughly about 2 to 2.5% per year. So if you were to take, $1 and you put that dollar inside of your mattress or under your mattress for a year, at the end of that year, that same dollar is not actually worth $1, but it's only worth 98 cents. And it happens with large scale, and it happens on a year-to-year basis across the globe, and it's just the power of inflation. It's where you get all those stories where, like, back in the day, a cup of coffee used to cost a nickel, but today if you go to Starbucks, it's gonna cost you an arm, joking, $5, $4. So the second question is, then how do you stop losing money, right? Everybody wants to know that. Grant Cardone's #1 rule in investing is never lose money. Well, what most people do is they take some of their cash, or most of it, and instead of putting it into an investment vehicle, they'll put it into a savings account, or what we call a high yield savings account, although high yield is more like 0.1 or 0.2%, which really means if you leave your money in there, you're gonna be earning that 0.1 or 0.2% on a yearly basis, but your money is still losing its purchasing power by roughly 2% per year. So all in, you're still losing money. What's the point of it? A key idea to keep in mind is that most banks don't actually keep their money in banks. So why should we? So let's put together some sort of hypothetical savings account. You put $100 into the savings account and it's gonna give you a yield of 10%. Over the course of 10 years, your $100 just became $259, and if you account for inflation, it's still $206, which is actually really good. You were able to double your money in 10 years without actually lifting a finger. Now, of course, no savings account today will give you that 10%. So the closest thing you can come to it is something like the stock market. So that brings us to the next point. What is an investment? And simply put, an investment is just something that continues to generate cash flow for you. So one of the most common investment vehicles is a rental property or an investment property. What ends up happening on an investment property is there's two ways you end up making money. You make money, first of all, by the rent payments. So let's assume you buy this hypothetical house for $100,000 and your monthly rent that you get from your tenant is $830 or $10,000 a year. At the end of 10 years, that property essentially paid for itself. 10,000 times 10, 100,000. The other way that that property would actually make money is just by appreciating in value. So if you buy a property in a developed country, statistically speaking, that house is probably gonna go up in value. And if you give it enough time, it may even double in value. So let's assume your property did. Congrats. So at the end of 10 years, you have the $100,000 that the property made, $10,000 over the period of 10 years. And then you also have the price increase of the property where now it's no longer worth 100,000 but 200. So if you were to sell that property, not only would you get your initial investment back, but you would also get an additional $100,000. And that's a pretty good investment. The problem with that also is that you need a ton of stuff and a ton of work to get into a property. You need to get a mortgage, you need to have a specific DTI, you need to go find the property, and then you need to have either you manage the company and the tenants yourself and collect the rent and work through the maintenance, or you hire a company to do it, and all of that eats away at the margin. And not to mention, not a lot of people have $20,000 saved up to just put down at a down payment, sometimes even more if you're not gonna live in the property and it's just a rental. So then we get to the stock market. Before we explain all the questions about which stock to pick and how to buy it and everything, I think it's important to understand what it is, right? So when you buy stock into a company, what you're actually buying is a single share of a company. If the company has 100 shares and you buy one share, you're essentially a 1/100th owner of that company. So it's important for you to know what the company does, how they operate, what's their product, what sector are they in, and how's that sector performing against the market, and all of that. It's very important for you to learn that and to do that study. So there are specific stocks that you can buy that actually work a lot like a rental property, as in there's two avenues to make money off of that stock. If you buy a dividend stock, which is something like Apple, let's say, when Apple has a profitable quarter, they will issue what's called as a dividend. That dividend is broken down equally based on how many shares you own. So if they issue a dividend for $100 and you are 1/100th owner of Apple, you're entitled to that $1 dividend. that's similar to the rental part of the investment property. On the other side, if Apple goes up in value, so for instance, if you bought Apple back in like 2010, where it was like under $9 a share and you bought 10 shares, you now bought $90 worth of Apple and you own 10 shares. If you fast forward to today, your same 10 shares would actually be worth $1,400. The price of Apple as I'm recording this video is roughly $143. So now, where do you actually buy a share? Like, do you go to apple.com and add an iPhone to your cart and then also add a couple shares of Apple? I wish it was that easy, but it's really not. Back in the day, you would call your stockbroker and say, hey Bob, I want to buy a couple shares of Apple and I'd like you to do that today, please. And then Bob would go in his little computer or notepad, New York Stock Exchange, place the order, and you would officially be a shareholder of Apple. Congratulations. Now today, there's a million different ways to do it. Each country has their own brokerages, and you have to, here in the US, they need to be registered with the SEC and comply to FINRA laws and all of these things. So the brokerage that I use is called Robinhood, and I'll put a link in the description below. Before you go buying shares, I'd like to talk to you about which ones you should buy, how to buy it. Robinhood is phenomenal. They have a great UI. They give you good notifications. Now, one of the issues I find with Robinhood, they don't give you a lot of data, but they started changing that after they went public. You now have an investor dashboard that you can see how well you're diversified, but they didn't have that back in the day. So you guys are essentially getting it easy. So Robinhood is phenomenal, but that leads us right to the next question. Now that you know what a stock is and essentially how to buy it, we'll do a purchase together at the end of this video. But which ones do you actually buy? Like, do I want to buy Apple? Do I buy Tesla? Amazon has been growing phenomenally over the past 10 years. Does that mean it's going to continue to do so? And that's a clear no, because past performance is not an indicator of future performance. So there are a couple of ideas that I'd like to throw out on which stocks you should buy. So what stocks should you actually buy it? I actually have a process on how I select my stocks and my ETFs and mutual funds and index and all of that, and I'll do another video in the future. But for right now, my recommendation is, especially if you're starting, don't actually buy individual stocks. Back in the 70s, a Princeton professor blindfolded this monkey, and he wanted to prove a theory that a blindfolded monkey could actually perform better while throwing darts at stock picks on the board than actual stock investors. So he made this internal bet / case study, and it turns out that his theory was correct. The blindfolded monkey beat the stock market pickers and gurus by a significant amount. You can check out that article. It's a pretty fun read. Now, I'm not telling you to blindfold yourself and throw darts into a wall and that you're gonna beat the market too. What I'm saying is there is a way to avoid all of that, have a lot more diversification, and that's by buying index funds. An index fund is essentially a two-part word. The index part is essentially the composite, a general composite of how the overall market is doing. So you take something like the NASDAQ, which is the technology sector for the US, you have the S&P 500, which is the 500 of the largest companies in the US, and you have all these countries have these essentially. The US has that and has the Dow Jones, which is 31 of the largest, the Russell 2000. So you can essentially buy a fund and you're pooling your money with a bunch of other investors, and you guys are buying one S&P 500. And that, for instance, I know just off the top of my head that's comprised of 6% of Apple, and there's 5% of Microsoft, 3% of Amazon. So when you buy one S&P 500 index fund, you're essentially buying a little portion of all of the 500 companies that are in the S&P 500. And the S&P 500 itself has performed better than a lot of the stock pickers and individual stock pickers and day traders. So if you're looking for essentially the easiest possible way to make money in the safest way, which that to me is actually important. Again, rule number one is don't lose money. Then your best bet is to just buy an index fund or an ETF. You essentially don't take a loss on your stocks until you decide to sell it. So for instance, the pandemic caused a pretty severe crash in the market for a week, right? If you had just gotten into the market right in mid-March and then late March it crashed and you sold then absolutely you would have taken a loss. But if you had just been more patient and held on to your stocks a little longer, there would have been a tremendous upside. The market is up probably higher than it's ever been since its inception. So isn't investing in the stock market risky? Yeah, absolutely it is. But essentially every investment is risky, and leaving your money under your mattress is also losing its purchasing power. So you have to make a decision on what to do with it. There's a lot of things you can do to minimize the risk. I'm not giving you investment advice, but there are a lot of things that even I didn't know back then. I wish I did. Like for instance, if you have a loss on one of your stocks, you can actually sell that stock and then claim it as a loss on your taxes, and the government will subsidize a lot of it during that tax year and even following tax year. That's one of the things Trump did, actually. The discussion I hate having with people is that they have a cousin who bought stocks and spent $200 on Apple, and the next day it crashed, and the next day it was worth $10. That doesn't just mean it's stocks. If there is an issue where like all of the S&P 500 companies go to zero, then your rental property probably is worthless as well. And there's probably something a lot worse than the pandemic happening where money is just not a thing anymore. So there's, again, ways where you can minimize the risk, but you can't just avoid it, and you can't avoid it everywhere else either. So just because you don't want to invest in the stock market because it's risky, well, so is real estate. Your house can burn down, get hit by a tree. There can be an earthquake, a tornado, a fire. I mean, again, everything is a risk. Everything in life is a risk. And you can't just avoid it just because your Uncle Bob lost $100 in Apple 12 years ago. So when should you actually start investing? If all advice is autobiographical, which I believe it is, then one of the advice I would give my younger self is start investing a lot sooner. I probably have my Robinhood app for many, many years, but I didn't actually put any money into it. I didn't understand the concept. I didn't build the good habit of actually just putting $10, $15 every day or a percentage of my salary and income in that. And I really wish I did. The entire investment world will agree here that the sooner you start, the better. And having like your investment account up for just an additional 5, 2, 3 years, it makes a significant difference, especially when you compound that over time. You're gonna see that the amount of money you would make if you started a couple of years sooner is tremendous. I'm not talking about a couple of basis points, we're talking about hundreds of thousands of dollars. So one of the last questions I wanna cover is just how much you need to get started. And it's really not a lot, it's a lot less than you would think. A lot of these brokerages, like even Robinhood, you can invest and buy fractional shares, like pennies, I believe, actually. I don't think that there is a minimum. They may want you to fund your account with a certain amount, but you don't actually have to buy the investment or spend all of that money. The other cool thing too, just to keep in mind, that a lot of these brokerages will give you like a debit card. So if at any moment you have money in your brokerage account that's not invested into stocks, you can actually use your debit card, make purchases like you would anything else. So there's really not a minimum for you to get started. You just need to get started as soon as possible and start building that habit. Even if it's $5, $10 a week, what you want to do is get into the habit of investing, even if it's small fractional amounts versus once in a lifetime, a massive lump sum. You really want to get that compounded interest behind you and in your favor as soon as possible. All right, so the last thing I want to do with you is walk you through how I actually buy my stocks and how we buy shares. So let's jump into Robinhood. Let's do a purchase together. All right, so we're here in Robinhood, and I opened up the Spider S&P 500 ETF. This is the fund we talked about. You'll see it's up about 1% today. My market value, it's essentially 18% of my portfolio, but since it's really an S&P 500, what it really is I have 18 of my portfolio mimics the S&P 500 to the percentage. So that's great. And then you can see here that I actually have a $20 pending dividend, which we also talked about earlier. So I'm gonna do one share. I'm gonna go to the drop down, and I like to do limit orders because I don't wanna pay more for a stock than I have to. So right now, this is trading for $4.91, for instance. It's good for the day, allowed to execute in extended hours. So I'm gonna do a final check. See, it's already up to $4.39. So should have placed it 4 seconds ago, but that doesn't matter. Again, we're dollar cost averaging. So I'm gonna do 38.98 and we'll go from there. See what happens. So your order, and it was complete, and I bought it for $438.90. It already dropped a little bit. What that really means is sometimes if it skyrockets, which it probably won't, but you end up paying more. And as you're doing this more and more and with more and more money, it does become to make a difference. Just like inflation compounded also makes a difference. All right, there you have it. That's how we would go about purchasing a stock. If you have any questions, drop them below. I'm happy to answer. Thanks, guys. See you on the next video.